All right, guys, we are going to be starting this unit with monopolies, something you probably already know some about, but I'm going to add the graphs, just like with perfect competition, and note the differences. The biggest difference is that a monopolist is a price maker. Last unit, we talked all about how the producers in a perfectly competitive firm were price takers, but now they have a choice because they are the only ones in the industry. And there's no close substitutes, so the consumers, if they want to purchase this product, pretty much have to purchase it from this one firm. So it gives them that power that they did not have in perfect competition. A price maker, and they also still are going to be advertising to the consumer because they still need the consumer to buy their product. So what we're going to see here is that although they are the only firm, the goods that these monopolists sell usually aren't perfectly inelastic. So they still are dependent on what the consumers are willing to pay for a good and how much they're willing to buy, which we'll really see that difference when we show this graph for a monopolist. And there are barriers to entry to keep competition from happening. I'm going to go over those barriers of entry first. The different barriers of entry are dealing with the fact that the monopolist owns a key resource, or the government has given them exclusive rights to sell a product, or finally, it's just a market where it's more efficient for just one firm to control the industry. I'm going to go into those three individually. So the owning a key resource, this doesn't really happen as much in the real world because we have private property, and that division makes it hard for one monopolist to own it. But we did see this a little bit in the 1800 monopolies with Carnegie and Rockefeller with steel and with oil. But their ownership of that key resource keeps other firms from entering into that market. But in today's world, that's not really a common reason why monopolists own the market. Now, the monopolies we do see in today's world tend to be because the government gave them a monopoly, which you've probably heard of patents and copyright before. This is the government granting exclusive rights to a firm, an individual, to sell the product. So if I invent something new, like if I invent a new form of medicine, let's say the cure for baldness, if I invent it and get a patent for it, I have the exclusive rights to sell that cure for baldness for a period of time. So it's a limited monopoly, let's say 10 years. So once those 10 years are up, anyone can sell that cure for baldness. But for the first 10 years, I am granted the exclusive rights to it and can make the profit from it. So this is to reward research and to reward those capital goods that we want. And you see these in a lot of pharmaceutical companies. They a lot of times look for patents on drugs because that's where they can really make profit. Once it goes generic and anyone can sell it, you see the prices really start to fall. And the final one, which I'm going to talk about more, is called a natural monopoly. This is a type of monopoly where it's allowed because it's just more efficient for one firm to control the industry. And why that is because in this industry, it has a really long range of economics of scale. And because of that, it makes it just more efficient for only one firm to control it. We're going to graph that and look at that towards the end of the lecture. These are examples of some allowed legal monopolies and known monopolies in the modern world. So you still see that they exist. In fact, in the city of Southlake, they do the public water, and so one firm controls the tap water that comes out. That is a legal, government-regulated monopoly. One other thing, it says local monopolies there. This may seem weird, like how are there local monopolies in businesses like airlines and movies and bookstores? Well, if you think about it, this is kind of a strategy for a business. Like Chick-fil-A is an excellent example of this. There's only one Chick-fil-A in Southlake, and that's on purpose. Chick-fil-A won't allow other Chick-fil-A's to open up within a certain mile radius of the one on 1709. Even if we may want it to, because they don't want one to open up and steal the business from the existing Chick-fil-A. So some businesses use this as a way to keep the business from competing against itself. Now, I know Starbucks doesn't have this strategy. There's a million Starbucks everywhere, but you will notice that in certain businesses, only one of them exists in a certain mile radius. That's a local monopoly that Chick-fil-A has in Southlake over how many Chick-fil-A's there are in a certain mile radius. So as I mentioned at the beginning, the monopolist is a price maker, but it's limited by the consumer's max price. So because of this, when we're going to be drawing the monopoly graph, instead of the demand line equaling price like in perfect competition, it's going to be a downward sloping demand line, just like the market demand line. So also in last unit, how we drew the side-by-side graphs for the market and the firm, you won't have to do this for a monopoly because the market and the firm are just one graph. So on this one graph, you're always going to be drawing a downward sloping demand line, just like you did in a normal supply and demand graph. And this is going to be important because it shows how much the monopolist can charge in terms of a price, to show that although the price may be higher than a perfectly competitive market, it may not be as high as they would like to make it because they're still limited by the consumer's max price. So this is comparing the two, like I just said. In a perfectly competitive firm, since there's just one price set by the market, the consumer in the firm is a price taker and the demand line was equal to whatever the price the market decided. But now, because the monopolist is dealing with the consumer's max price and it changes based along the demand line, and it goes hand in hand with that law of demand, that if the price is higher, consumers will buy a smaller quantity, and if the price is lower, the consumers will buy a larger quantity. And so the monopolist will look at this when determining if he wants to, for example, lower the price, he'll be able to sell a larger quantity. Or if he raises the price, he'll have to sell a smaller quantity. So that's a common AP question. If a monopolist raises the price, what will happen to the quantity? It will fall. It has to go inverse, just like the law of demand. And that's showing, again, the demand line's downward sloping in a monopolist graph. So they still measure total revenue by price times quantity. And average revenue, just like in the Mr. Darp in perfect competition, is still equal to price. But now, because the demand line's downward sloping and it changes based on the quantity, marginal revenue is going to be its own separate line. So it's not going to be the full Mr. Darp that it was with perfect competition. Demand is its own downward sloping line, and marginal revenue is its separate own downward sloping line. And we can see this if we set up price compared to quantity compared to total revenue. The marginal revenue starts to go down as the quantity increases to where it actually can go negative. So the line for marginal revenue you're going to see on the monopoly graph actually going negative, and you're going to have to take note of where it goes negative to show an important point. The reason why it ends up going negative is because when the monopolist wants to sell a larger quantity, it not only has to lower the price at that larger quantity, but all the previous prices before. So it ends up putting the marginal revenue lower than the price and lower than the demand line. So because of that, that's why it ends up being a lower number and falling negative. So this goes into that more. So they can't just sell a larger quantity at that lower price. They have to sell all the previous units as well at the lower price. So here's how it ends up looking. And this is how you'll draw the demand and marginal revenue line on every monopoly graph. So take note of this. And you will have to take note of where it goes negative right here, because that will lead to an important point I'm going to get to in a minute. But it'll always fall below, and then it'll get lower and lower until it's negative. So what this means when we see this is that this is the linear demand line we learned with elasticity when we covered that in Unit 1. So because of that, and you may have forgotten what that means, the linear demand line, because it has a constant slope, had the three ranges, which means every monopolist line has the three ranges: elastic at the top, unit elastic in the middle, and inelastic at the bottom. This is important because this affects total revenue for the firm. If the firm is charging a price on the elastic portion of the demand line and they want to raise the price, well, if you remember elasticity, if you raise the price of an elastic line, total revenue falls. If you lower the price of an elastic line, total revenue rises. So a common AP question with this is, on this portion, where my mouse is, of the line, would the firm's total revenue increase or decrease if they raise the price? Well, it's the inelastic portion. So if they raise the price of an inelastic portion, total revenue will increase. So you have to remember that connection between total revenue and elasticity with the monopoly. Because of this linear demand line and the different ranges, the monopolist has to know how their total revenue is going to end up being affected if they raise or lower the price. The other thing to note, how do we tell where the middle is, where it goes from being elastic to inelastic? It's where marginal revenue intersects the x-axis. At that point, when marginal revenue is 0, that is the unit elastic point. And below that point is inelastic, and above that point is elastic. So knowing where marginal revenue is at 0 is essential to telling which part of the demand line are you at. Good news, that was a lot of new information. But we still determine the profit maximizing quantity the exact same as we did in perfect competition, where marginal revenue equals marginal cost. So you're still finding that point. The difference is marginal revenue is not equal to price in this case, it's below it. So you're actually finding the specific marginal revenue line and looking at where it intersects marginal cost, and that is your profit maximizing quantity. So that is the quantity the monopolist will always want to sell. So that's how you determine output. Then what you're going to do after you find that point is go directly up from that profit maximizing quantity to where it meets the demand line. Think about it. The monopolist is limited by the consumer's max price. So they're going to sell their profit maximizing quantity, and they're going to charge the price from that consumers are willing to pay. So because of that, the price won't be at the same point where MC and MR intersect. That's where the quantity will be. The price will be above that to where it intersects the demand line. You still measure profit based on where it is compared to ATC. If price is above ATC, you're making a profit. If price is below ATC, you're making a loss. So that also is the same as perfect competition. So here's our basic monopoly graph set up. We have our marginal cost line, marginal revenue line, demand line, and average total cost. Average variable cost they don't usually have on here. I mean, if you think about it, it's just going to be way too crowded if you put average variable cost. But if it asks about shutdown, the same rule applies. We use AVC to determine should the monopolist produce at a loss or shut down. So as I mentioned, profit maximizing quantity is where marginal revenue and marginal costs intersect. So you'd go from here down to the Q, and that would be the quantity that the monopolist would sell. But to determine the price, it's not right here. You take that quantity and go up to where it intersects the demand line. That is the price they're going to charge, because that is the maximum price the consumer is willing to pay at that profit maximizing quantity. So that's the quantity, but that's the price. So comparing the two, before price equaled marginal revenue and you set it equal to marginal cost, and that's all going to be in one place, which was why perfect competition was allocatively and productively efficient. But now price is higher than the marginal revenue equals marginal cost. So price is never going to equal marginal cost in a monopoly. So it's not allocatively efficient. And then, as I said, it's also not productively efficient because price is not at the minimum of the ATC. So I mentioned this last unit, but it holds. Perfect competition is the only one in long-run equilibrium that is productive and allocative efficient. A monopoly is neither. And monopoly doesn't have a long-run equilibrium graph. It's just the one graph that I showed you. It doesn't move to long-run equilibrium over time because there's no entry and exit of firms because there's only one firm. So if I wanted to measure a monopolist profit, just like before, the price, but the price is again where it hits the demand line, compared to the ATC and over. So this square right here would be the monopolist profit. A monopolist almost always makes profit, but they can make a loss if the ATC is above the price they're charging on the demand line. We'd measure it just like we did in perfect competition. The price we're charging compared to the ATC and over. So that's the same exact concept. Price compared to ATC is how you measure profit and loss. And yes, they can make a loss, doesn't happen as often, but as I mentioned, they determine shutdown where the ABC is. As long as price is above it, they'll still produce at a loss. So the next thing is deadweight loss. So we are not at the quantity that is socially efficient. So just like we looked at with externalities and taxes, that means there's going to be a wedge for deadweight loss. This wedge represents between where the monopolist is producing and where they want to be if they were socially efficient. And the wedge will look a lot like the tax wedge, comparing where we should be and where we are. This will end up being the deadweight loss. We see the triangle just like in taxes and externality, the difference between where we should be if we were at the socially efficient quantity and where we are at the monopolist quantity. So the socially efficient quantity is where marginal cost and demand intersect. Where we're at is below that. So that triangle, that wedge that we're at that's less than where we should be is the deadweight loss. And if we look at it in terms of consumer and producer surplus, we still have the consumer and producer surplus kind of like before, but the consumer surplus is going to be smaller than in perfect competition because the price is higher than in perfect competition, decreasing the consumer surplus and increasing the producer surplus. And then there's that extra left over that nobody gets. The producers don't get, the consumers don't get, nobody gets, which is showing a monopoly is inefficient because it has that deadweight loss. Okay, the last topics go with how the government regulates monopolies. You know monopolies in the United States are illegal, and the government has a hand in either preventing them from happening or regulating the ones that do exist that are seen as more efficient being a monopoly. So they can do several things. They can do nothing at all. They can just let the monopolist operate. They can take over it, so turn private into public where the government controls it. They can regulate the amount the monopolist sells, or they can regulate the industry to make it to where firms can either enter in or stay in business. So sometimes you'll see them prevent firms from going under, like Apple was prevented from going under because we needed them as competitors, or you'll see them prevent mergers from happening. So if there's more than one firm, the merger would limit the competition. By preventing the merger, they're keeping the competition going. So as I said, they can break up mergers, they can break up companies into smaller to make sure there is a competitive market. Or if they allow a merger to happen, and you see this a lot, like you saw this with US Airways and American merging, you're seeing this with the phone companies merging right now, they may allow them to merge, but they're regulating how much power they have. I know when US Airways and American Airlines merged, they allowed them to merge, but they limited how many terminals they would have at each airport. That way they couldn't dominate an entire airport. There would be terminals open for other airlines. So sometimes they'll allow it, but regulate the merger and the size of the company that's created when the merger happens. All right, so here is a new graph. It's a type of the monopoly graph, but it's a natural monopoly graph. As I mentioned before, a natural monopoly is an industry where it's just more efficient for only one firm to control the industry. And the reason why is because there's such high fixed costs that the average total cost line ends up decreasing for a huge portion of time, meaning the long run average total cost is experiencing economics of scale for a long portion of time. So because of that, it's just more efficient for one firm to control it. So it still has the marginal revenue, marginal cost, and average total cost in the demand line. However, the long run average total cost is a different shape, which also means the marginal cost is a different shape. Because again, it has to be in that portion, the economics of scale portion, that as output rises, costs fall. So it looks a little bit different. Now, I haven't seen them have you draw this on an AP exam, to be honest, but I have seen multiple choice questions asking about natural monopolies. So you still need to have the graph in your brain and know the ATC is different in a natural monopoly, because otherwise the answers end up being a little different. And when we talk about overseeing and regulating a natural monopoly, you need to have it set up like this for it to work. A good example of a natural monopoly is tap water. I already mentioned this as an example of a monopoly that's allowed to happen, but when you think about tap water, they allow one firm to have it because when they're setting up this system, they're costs are super high. They have to build these sewers and build these pipes for an entire city. If you had more than one firm doing that, it could be destructive and just not efficient. So to have one firm doing it is the best way. So they allow them to have control over this. That and water is such an inelastic good. We don't want firms having too much power over the price of what they sell. So the government oversees the prices of this tap water. And that is how we look at regulating a natural monopoly. So I still have my graph with the ATC having a long range of economics of scale. And the government can look at this natural monopoly and say there are 3 different prices they could charge. This is the price the monopolist wants to charge. That's the price above where marginal revenue and marginal costs intersect. So that's the normal price the monopolist would charge that would optimize their profit. The socially optimal price is right here, where marginal cost intersects demand. So if they charge the monopoly price, there's going to be a huge deadweight loss. The problem, though, is if they charge the socially optimal price, what we notice is this socially optimal price right here is below the minimum of the ATC. So this monopolist, if they're charging the best price for society, is going to be making a loss, and if that continues and continues, won't be staying in business. So we have kind of a compromise price, a fair return price right here, where it's not all the way to the socially optimal price. So we still have a little bit of deadweight loss, but a lot less deadweight loss than the price the monopolist wants to charge. And if they're right here, they're breaking even. So they're charging the same price that they would in a perfectly competitive market, where they're at that long run break-even point. So this is a point the government a lot of times decides to charge, the point where the business can still stay in, but not all the way up to where they want to be and make the profit at the high price with the huge deadweight loss, but not so low that they might go out of business. So those are the 3 prices: the monopolist price, the fair returns price, which is where it intersects the ATC because that's their break-even point where they can make normal profit, and the socially optimal price, which is what would be best, but they couldn't stay in business at that low of a price. The last topic is price discrimination. Price discrimination is something that, when you see the definition here, it looks very extreme, and in its most perfect form is extreme. But on small scales, you guys see this all the time. Price discrimination is when firms know the consumer's max prices. They know that each consumer has a different max price depending on the good. And if they're a monopoly, they have the power to charge each consumer that max price. So if they have the power to charge each consumer that max price, that means that they can charge someone $10 for coffee, someone $8 for coffee, someone $2 for coffee, depending on each individual consumer's max price. Okay, so yeah, in the perfect example, it sounds extreme. But when you think about things like movie tickets, they charge a different price for seniors, a different price for students, and a different price for just working adults. This is because they know seniors and students have a lower max price than working adults. So because of that, they're price discriminating. Or you can see this at like airports. Airports, when you're trapped inside, you've gone through security. If you want to buy a bottle of water once you get inside, it's like $4. Versus if you were at the gas station outside the airport, it would be less than $1. Because the airport knows you have a higher max price than you would if you were outside the airport. So that's price discrimination in the real world. Same thing with theme parks, concert venues, athletic events. They all price discriminate because they know that your max price is higher in those specific scenarios. So for this to happen, they have to have some market power. So that's why it happens in a monopoly graph, because the monopoly, we can't go to someone else and buy it. In a monopoly graph, they're the only person we can buy it from, so they're the ones who are able to price discriminate. And perfect price discrimination is that extreme scenario I just said, where each consumer is charged their max price. Now, this wouldn't really be ethical in the real world, so perfect price discrimination isn't one that exists as much, where each person has to pay a different price depending on their max one. But on smaller levels, it happens all the time. So with this, it sounds like a bad thing, but there's a weird positive side effect of price discrimination. It reduces the deadweight loss. Because if they're charging each consumer their own max price, they're able to charge prices along the demand line and move us closer to that socially optimal point. It also completely gets rid of consumer surplus because we're paying our max price. There's no price below it that we can pay. So the monopolist profit, producer surplus, is higher. But on the society side, it does help eliminate deadweight loss. So here's some examples that I just said. But if it was perfect price discrimination, it would go from charging here and the profit being a normal amount to having all profit. So as I said, completely gets rid of consumer surplus, all of its producer surplus. But then we also notice right here, where we're now producing at is where marginal cost and demand intersect. That's the socially optimal point. So it also gets rid of deadweight loss. So it's not all bad. I mean, it's not going to really happen in the real world, but a weird positive side effect of that is price discrimination can help move us closer to that socially optimal quantity. All right, guys, this is all of the notes for Monopolies. I hope you have a wonderful day.